Good afternoon, everybody. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for our weekly wrap-up. Graham, what's been going on in the market this past week?
Yeah, thank you, Stacy, and thanks for our listeners on being on the call. Pretty interesting week, kind of a narrow range that the U.S. equity indices kind of traded in, kind of mixed in performance, even though we had a pretty tame consumer inflation report. If we look at the NASDAQ rose about 0.4, where we saw the S&P 500 fall about 0.3. We saw the Russell 2000 slide about 1%. And the sector breadth was largely negative across the board. We did see the defensive sectors really be the outperformers for the quarter. If we switch over and look at U.S. Treasury yields, we did see them tumble a pretty good bit after April CPI numbers showed that headline prices rose at a slower annual rate. So we had core inflation pretty sticky, about 5.5%, pretty much due to that high rent cost. We did see some evidence of some falling shelter expenses. We saw U.S. producer prices rise, but less than expected in April. And we looked at the weekly jobless claims jump to about 264,000. Now, that was the highest reading that we've seen since 2021. We did see consumer sentiment really plunge for 6 months at 6 months lows as the debt ceiling concerns continue to put some anxiety into the market and consumers. Household spending is anticipated to decrease pretty significantly over the next year, corresponding with some declines in inflation outlook. Not really surprised with that since we're kind of exposed to some higher credit standards, maybe some weaker loan demand, with not just the debate with the debt ceiling, but I think also what's been really going on with the regional banks and how that may affect the commercial real estate market, lending, so on and so forth. If we go overseas and think about internationally, you saw the Bank of England raise interest rates by 25 basis points to about 4.5%. Keeping with their hawkish tone, but removing, and I think this is really interesting, removing their recession possibilities from their economic projections. But at the same time, we only saw the economy grow about 0.1%. So that's kind of interesting that they're removing their economic concern in terms of a recession, and they grew so slowly. March GDP slumped about 0.3% as poor weather and inflation hit some service sectors. If we think about Germany, Germany's really slowing. We saw some production spur some recession fears over there. And if we continue to look at China and their reopening, so on and so forth, really suggested still some weak domestic demand over there, spurring the anticipation that they're probably still going to have to take a very strong stimulus stance where we're more in a tightening stance to kind of lower demand here. They're trying to increase demand over there.
Okay. Well, Graham, you mentioned the debt ceiling. What are your thoughts on that?
Well, that's interesting. Since World War II, I think it's about 100 times that they've adjusted or revamped the limit on the debt ceiling. So to me, that looks like 100 times that they've kicked the can down the street, and I wouldn't be surprised it's at least 101 or whatever it's going to be that they kick the can down the street. It doesn't mean there's not concerns. It doesn't mean they're not going to take it, to the last possible moment to make that decision, which is going to just add additional anxiety to the market, which might cause a bit more volatility. But again, I do think the can's going to be kicked down the street. I wish they could come up with a long-term fix on this. Probably kick it down the street, maybe shove it into the budget when we get to latter part of the year.
Okay. Well, what about low risk interest rates? Are those still attractive for investors?
Yeah, if we're talking about very, very, very short term, in the matter of months or a year, treasuries all the way up to money fund accounts. Again, a lot of money market accounts. We're getting somewhere around 0.35, maybe 0.5%. I might be giving some credit there. But yeah, these money fund accounts, CD rates for 1 year approaching 5% or just over 5%. I look at it this way, Stacy, is investors have options. They didn't have options over the last decade. interest rates were so low, the Fed funds rate was so low. So they had to go into stocks. They had to take a lot of risk. But now you have options. You have options in the bond market because now maybe you can get good income and a capital appreciation, as well as in these money fund and CDs. So there's options where they just weren't maybe as attractive or anywhere as attractive over the last decade.
All right. Well, thank you so
Yeah.
much, Graham. And thank you to our viewers for joining us today. I do want to remind everybody that we have a few events coming up. And the first one is our fourth annual car show, which is coming up just a month away in June, mid-June. And we would love for you to mark your calendars and make plans to join us for that. It's always a lot of fun, a lot of cool cars to look at, and just get a chance to catch up with everyone. So please make plans for that, and just be mindful of our website and our social media accounts. We always put the latest and greatest information on those so that you can stay up to date on everything that we have going on. So thanks again for joining us today. We'll see you again next week for the weekly wrap up, and we hope you have a fantastic week.
Take care.